Hi, I'm Mark Roach, FutureWise Energy. I always find it interesting to look back and see how much things have changed from this period now to maybe a year or 5 years or 10 years ago and see if there's really been any significant changes. And to cut right to the chase, I see just a minor change from about a year ago, but let's go into the details. I did a comparative analysis of US oil and gas rig counts. Also looked at WTI oil prices and Henry Hub natural gas prices between November 2023 and March 2024 versus a period more recent, November 2024 into March 2025. The U.S. oil and gas industry provides a critical lens into energy market dynamics, with rig counts, West Texas Intermediate, crude oil price, Henry Hub natural gas prices serving as key indicators. Now, this analysis compares these two periods, November 1st, actually 2023, to March 1st, 2024, and November 1st, 2024 to February 28th, 2025, examining trends in total rigs, oil rigs, gas rigs in the US, WTI oil prices, and Henry Hub gas prices. Drawing from Baker Hughes weekly rig count data and price data from the US Energy Information Administration, the EIA, and other industry sources. So we observe distinct differences in operational activity and market conditions between these periods, reflecting broader economic, environmental, and geopolitical influences. In regard to total rig counts, the total U.S. rig count, encompassing both oil and gas drilling rigs, reveals a stark contrast between the two periods. In 2023 to 2024, the total rig count remained relatively stable, relatively flat, fluctuating between 616 and 629 rigs, with an average of approximately 622 rigs over that period. The period began with 625 rigs on November 3rd, 2023, and dipped to a low of 616 on November 17th and rose steadily to a peak of 629 by March 1st, 2024. A net increase of only 4 rigs, 0.6%. This stability suggests during that period there were consistent operational paces, and it was likely driven by sustained oil prices above $70 a barrel, a need to maintain production levels despite softening natural gas markets. In contrast, the 2024 to 2025 period saw a lower and more volatile rig count, ranging from 576 to 592 rigs, averaging around 585 rigs, roughly 37 rigs below the year's prior average. Starting at 585 rigs on November 1st, 2024, the count dipped to a low of 576 on January 24th, 2025, the lowest since December of 2021, before recovering to 592 by February 21st, 2025, and settling at 590 by February 28th. This downward trend reflects a broader industry shift, with Reuters and other sources noting a 20% annual decline in 2023 and continued contraction into 2025 attributed to improved drilling efficiencies, consolidation amongst operators, and weaker natural gas prices earlier in 2024. In regard to oil rig counts, oil rigs, which target crude oil production, followed similar trajectories to total rigs, but with nuanced differences. In 2023 to 2024, oil rigs averaged about 501 rigs, starting at 505 on November 3rd, dropping to 497 by February 16th, 2024, and rebounding to 506 by March 1st, a net gain of just one rig, 0.2%. The range 497 to 506 indicates a tight operational band supported by WTI prices averaging $76 to $82 a barrel in November 2023 and stabilizing around $71 to $78 a barrel through early 2024. This consistency aligns with producers maintaining output and moderate but reliable demand. For 2024 to 2025, oil rigs averaged 497 rigs, a decline of 22 rigs, 4.4% from the prior year's average. This period began at 479 rigs and fell to 472 by January 24th, 2025, and peaked at 487 on February 21st before easing to 485 by February 28th, a net increase of 6 rigs, 1.3%. The lower baseline reflects caution amid WTI prices starting at $68 to $71 a barrel in November 2024 through a mid-period rise to $74 to $76 a barrel in January and February 2025, spurred by a slight uptick in activity. The year-over-year drop underscores a shift toward efficiency, with fewer rigs needed to sustain production levels due to technological advancements. Now, in regard to gas rigs, gas rigs targeting natural gas, of course, exhibited more pronounced declines across both periods, reflecting market oversupply and price volatility. In 2023 to 2024, gas rigs averaged 119 rigs, beginning at 118 on November 3rd, dipping to 114 on November 17th, and peaking at 121 by February 16th before settling at 120 by March 1st, a net increase of 2 rigs, 1.7%. Despite this stability, Henry Hub prices fell from $3 per million BTUs in early November to a record low of $1.51 per million by March, driven by high inventories and mild weather, which limited drilling incentives. In 2024 to 2025, gas rigs averaged 101 rigs, 18 rigs, 15% below the year's prior average in this period, starting at 101, dropping to 99 in January 2024, and recovering to 103 by February 14th before, let's say that again. In 2024 to 2025, gas rigs averaged 101 rigs, 18 rigs, 15% below the prior year's average, starting at 101, dropping to 99 by January 24th, and recovering to 103 by February 14th, before ending at 101, no net change. The lower account aligns with Henry Hub prices hitting an all-time low of $1.90 per million BTUs in November 2024, though a January 2025 spike to $4 to $4.13 per million, with a daily peak of $9.86 on January 17th, due to a cold snap briefly boosted by activity. The subsequent decline to $2.60 per million BTU by February 28th reflects a return to oversupply conditions, constraining gas rig growth. Now, in regard to WTI oil prices, WTI crude oil price as a benchmark for U.S. oil markets showed divergent trends. In 2023 to 2024, prices averaged $75.80 a barrel across the period, starting at $82.50 per barrel on November 3rd, dropping to a low of $71.50 per barrel on December 15th, and rising to $77.50 a barrel by March 1st, a net decline of $5 a barrel, about 6%. The initial high reflected post-summer demand and geopolitical tensions, while the December dip tied to global demand concerns that was offset by a late recovery as supply tightened into 2024. In 2024 to 2025, WTI prices averaged $72.47 a barrel, $3.33 per barrel, or 4.4% below the prior year, ranging from $68.20 a barrel on December 6th to $76.50 a barrel on February 14th, ending at $70.12 a barrel on February 28th, a net decline of $1.38 a barrel, 2%. The lower starting point, $71.50 a barrel, reflects weaker demand outlook in late 2024, with a January-February rise tied to supply constraints and seasonal demand, though the late February price drop suggests market corrections or inventory builds. The year-over-year decrease aligns with reduced rig activity, though prices remain sufficient to support modest oil rig growth. In regard to Henry Hub natural gas prices, Henry Hub natural gas prices displayed significant volatility, driven by weather and storage levels. In 2023 to 2024, prices averaged $2.49 per million BTU, starting at $3 on November 3rd, declining steadily to $1.51 per million by March 1st, a drop of $1.49 per million BTU, or 49.7%. This collapse, one of the steepest in recent history, resulted from record production, 103.8 BCF in 2023 from the EIA, mild winter weather, and storage levels 22% above the 5-year average by February 24, suppressing drilling incentives despite stable gas rig counts. In 2024 to 2025, Henry Hub prices averaged $2.91 per million BTU, or 42 cents per million BTU, 16.9% above the prior year, but with the greater swings from $1.90 per million on November 8th, an all-time low, to $4.13 per million on January 10th, then down to $2.60 per million by February 28th, a net increase of 35 cents per million BTU, 15.6% from November 1st, 2025. The November low reflected continued oversupply, while the January spike, peaking daily at $9.86 per million BTU, tied to a severe cold snap, boosting demand. The subsequent decline mirrors high storage and mild late winter conditions. Though prices remained above 2024's lows, supporting a slight gas rig recovery. So here's some comparative trends and insights. Comparing the periods 2023 exhibited higher rig counts, averaged 622 versus 585, and a more stable operational profile, underpinned by WTI prices averaging $75.80 a barrel versus $72.47 a barrel in 2024 to 2025. However, Henry Hub prices crashed to $1.51 per barrel by March 2024, undercutting gas rig incentives, while 2024 to 2025 saw a volatile but higher average, $2.91 per million BTU, with a January peak briefly reviving gas activity. The 2024 to 2025 period's lower rig baseline reflects industry consolidation. Efficiency gains, for example, longer laterals, multi-well pads, and a 6 to 7% year-over-year rig decline, consistent with what the EIA and Reuters are reporting as reduced drilling amid softer energy prices earlier in 2024. Oil rigs tracked WTI prices closely in both periods, both with 2023 to 2024 higher counts, 501 versus 479, tied to stronger pricing, though the 2024 to 2025's late recovery suggests responsiveness to the mid-$70s per barrel level. Gas rigs, however, diverged. 2023 to 2024 stability 119 average, defined falling Henry Hub gas prices, while 2024 to 2025's lower counts, 101 on average, aligned with initial gas price weakness, only rising with the January spike. Overall, 2024 to 2025 reflects a leaner, more reactive industry adapting to lower oil prices and volatile gas markets, while 2023 to 2024 maintained higher market activity despite a collapsing gas sector. These trends highlight the interplay of price signals, weather, and operational strategy, with 2024 to 2025 signaling a cautious industry poised for selective growth as prices stabilize, contrasting with 2023 to 2024's broader but less agile drilling footprint. I'm Mark Roach, wishing you all the best.